Good morning, everyone. Today is Tuesday, November 9th. I'm here with my two brilliant partners, Marina Parkin and Jackie Durham, and we are going to be talking to you today about corporate entity structure and setup. So we're going to be exploring a little bit down the path between sole proprietorships, corporations, LLCs, and of course, we'll have the tax implication of those types of entities as well. So as always, you are welcome to ask any questions that you might have at the bottom. If you'll use the Q&A box, that's easiest for us to make sure we get your questions answered as we roll. And these webinars are always recorded, so it will be available for distribution on our YouTube channels, on our website, Koontzassociates.com and KoontzParkin.com, and also on our Facebook pages. So if you can't get enough, you can get it again or share it with your friend. So this tag team will promise to be full of fun and interesting information. So we will not leave you we will not leave you bored. We might leave you confused, but as always too, if you have any other topics you'd like to hear about, you're welcome to drop us a line and let us know what you are interested in, so that we can continue to bring you helpful content. So thank you so much, ladies. It's Tuesday again. Here we go, right? So we've just kind of finished up a session on year-end tax planning, and that got into a lot of business information. So one thing I wanted to do was make sure that we kind of circled back the wagon around the corporate structure. Again, the year-end is always a good time to do this. So I wanted to give Jackie a chance to kind of start with what our choices are. And then Marina, you can kind of tell us, interject with how these choices will be treated differently for tax purposes as we go along, if you don't mind.
Absolutely. Right. Well, I guess we'll just start with sort of what your legal options are for entities. The first is, if you don't want to form a formal entity with the state, you'll be operating your business via a sole proprietorship. That's probably, not your best bet. That's something we don't typically recommend. The pros of a sole proprietorship, I would say, are you don't have the legal expense of forming the entity or maintaining corporate governance, or even having a separate tax return. But on the other hand, you're completely exposed to liability from the operation of your trade or business. So your personal assets are going to be exposed to the creditors that arise from the operation of your business, and likewise your business assets that you own and hold for operation of your trade or business are also going to be exposed to your personal creditors. So the scope of liability exposure really goes both ways, and it's pretty broad, and you're really just completely exposed out there to both your business and personal creditors whenever you operate as a sole proprietorship. So sole proprietorship really just means that you're operating in your individual capacity. So even if I'm Jackie Durham and I'm out there operating a roofing business, and I might have Jackie's shingles on the side of my truck, that doesn't mean that I'm an entity. That just is a name that I'm trading under. So you're still exposed, even though you're operating a business. That does not mean that you're afforded any of the liability protection that would come from a formal legal entity. So it's definitely something to think about. Some folks try to get their feet wet a little bit, see where the business goes before investing in the formation or incorporation of a legal entity. I can certainly appreciate that, but at the same time, you really need to think about the assets that you're exposing to liability by doing so. When it comes down to it, the expense of forming and properly maintaining an entity pales in comparison to the large amount of liability that you can face from a very innocent mistake or accident that can happen. So I'll start there. The other two entities that we're going to kind of focus on today, there's also partnerships. We're not going to dive too deep on partnerships today. I feel that those are not very common anymore. I feel that some clients unknowingly stumble into partnerships because they might be collaborating with a business partner, but not forming a legal entity. And without knowing it, they've actually formed a partnership, and now the actions of their partner can be held against them and can come back on them from a liability standpoint. which is another reason why I think it's extremely important to form a legal entity, whether it be an LLC or a corporation. So that would bring
Jackie,
me
let
to.
me jump in on the tax side then of the sole proprietorship before we move into the formation of the entity. I do see quite a few businesses, and just like you said, it's typically when the person is trying to get their feet wet a little bit and saying, is this a real business? Maybe it used to be a hobby and now they're kind of wanting to start it as a business, or they're just trying to see if it sticks, and they really are at the point where they don't want to spend any money on any of the legal stuff. So they're not necessarily understanding the importance of liability going both ways, as in protecting other assets that they have from anything happening in this business. Not necessarily that there's much assets in the business yet, but that concept, you have to wrap your head around it a little bit. So when I see these folks on the tax side, it's typically like, oh, we're just starting, let's just see where it goes. The easy part, I guess, always the benefit of a sole proprietorship is, like you said, there's not a separate tax return you have to file. So the income and expenses are going to be reported on what's called Schedule C, which is a schedule that's part of your personal tax return, and it's called profit or loss schedule. And that's where you would show your revenue and your expenses. And it's got a good variety of things you can list in there and capture all of the expenses that you would under any other type of business. And there's no dollar value, limitation on how big you have to be before you move into it. You can have, millions of dollars on your Schedule C. The thing I do have to say on the flip side of it is that IRS, Schedule C's are pretty good for not necessarily raising a red flag, but it's kind of that a low-lying fruit for IRS to look at. In fact, when they are trying to focus their audit effort on where they can get the most money, they are going to look at the business schedules, those Schedule C's that make a lot of money. So if you're a small business and maybe you're whatever, not a specific threshold, but say you're under 100,000, you're probably not too attractive to IRS to dig into it. But if you've got $1 million on your Schedule C, you bet somebody's going to pay attention, because they know you're writing off all sorts of stuff in there. That usually those are the same folks that don't have a separate bank account. They may have taken one credit card and dedicated it to a business use and put everything on the business card just for tracking purposes. But that doesn't mean that when they're in Home Depot and they've got Jackie's shingles and they have to buy some extra tools, that they don't have their card that they've dedicated, because that's in the truck and now they have to pay for it, and now in the pocket is the personal debit card, and they use that. So the commingling there is everywhere, because you don't really know what you're doing and everything is coming out of everywhere. You've got personal expenses and business expenses. So it is a ripe area for IRS to find things that are written off that are not necessarily business related. So that's where a lot of times it's if I cannot convince a client of the legal liability importance, I start with the IRS audit.
That's always my strategy too. I'm like, if you don't mind legal liability and Morgan and Morgan for the other people, then maybe you'll mind a tax bill.
yeah, absolutely. And honestly, they kind of look at things like what do you have in there? There's a mileage piece in there. There's also home office piece that feeds into it, which also IRS is not a big fan of home office. They allow it, but then they'll be like, well, let me see that you calculated it right and didn't take too much. So there's also a slew of issues with that, but it is an easier way definitely to start. And if you are a small business, and as Jackie is going to get into the formation of the LLC, that Schedule C is still a good option for you until you hit a certain dollar thresholds, and we'll get into that in a minute here. So that's kind of my tax spiel on it.
Yeah. Well, and when I'm sitting in the consults with people, lots of times they're like, my CPA said my business, I don't really need an LLC yet. And it's like, well, maybe for tax purposes, but you can have liability while you're still producing a loss. So it's still not, it's a great tax answer. It's a terrible legal answer. And we shouldn't be getting legal advice from CPAs. So
that's tax advice.
Right. Yeah. So stop asking your CPA for legal advice.
And hopefully they'll stop proffering legal advice improperly.
Exactly. So that's probably the biggest thing that I run into is people are like, well, I just thought my business wasn't big enough. It's kind of the same thing when we had Kate Smith on a couple of weeks ago about estate planning. Like people think I don't have enough money to have a trust. There are these just like assumptions people make where they think I'm not wealthy enough, fancy enough, worried enough to need some big business structure. And you can have a really protective, insulative business structure without having it be too complicated. So that's
right. And it's, it's very, I love Joanne's example that she's offered a couple of times, comparing, the legal services and making sure that you're structurally sound from a legal standpoint to auto insurance. And, everyone will brag about, well, I haven't gotten into a wreck in 15 years. And, well, you're still carrying insurance that entire time because it's a possibility. And it doesn't mean that tomorrow you won't go out and get nailed. So it's something that it's a protective measure that is no different, in my opinion, than an insurance policy. So,
and it's an inexpensive insurance policy at $130 bucks a year that the state's going to clip you for. So you cannot buy insurance that cheap.
Right. And you can't go back once you do get into a legal battle and there's some liability and you have Morgan & Morgan knocking at your door. You can't go back and now form an entity and insulate yourself from liability. You kind of have to do that now. And it's part of planning and protecting yourself and your family and your assets. So that leads us to the next entity that we were going to touch on. And something I also just want to mention is, Marina's going to get into the different tax structures, but I think it's very interesting how many articles I bump into out there that says, should I be an LLC or an S-Corp? Well, they're not mutually exclusive. They're two different designations. A corporation under Florida law is a legal corporation. An S corporation or a C corporation is a tax designation. And that's something that an LLC can elect. That's something a corporation can elect. So I just want to throw that out there real fast to clarify that, because I can't tell you how many confusing articles I've just stumbled across myself that I've noticed where it can really confuse readers. So anyways, our next legal entity that we're going to touch on real fast is the Florida Corporation. And this is one that has sort of fallen out of favor with a lot of our clients just because it's a little more cumbersome from a maintenance standpoint, for good reason. And, if you go under, nobody except me is going to go under the Florida Business Corporation Act. But, because we mostly deal with LLCs, I went through and tallied all the different things that you have to have as a Florida corporation. You have to hold annual meetings. You have to have bylaws. You technically have to have directors unless you specifically waive them via shareholders agreement. There's just all these spider webs you have to kind of climb through, and that you should be climbing through with the assistance of an attorney. If you are a corporation, it's a little more cumbersome from a formation standpoint, the steps you have to take to formally actually incorporate. And also it's from a day-to-day management and annual management standpoint, it carries a lot more requirements. And the whole purpose behind having a corporation or an LLC is to insulate yourself from liability. And if you don't treat your entity as a proper separate entity, which means operating in accordance with Florida law, and it also means operating in accordance with your bylaws if you're a corporation and your shareholders agreement. If you go awry of those requirements, that's going to compromise the integrity of that corporate veil. And that's going to expose you to that liability, which defeats the whole purpose. So when you're operating through a corporation, you need to make sure that you're being very, very careful and that your attorney's being careful to guide you properly, because you can misstep without even realizing it, in which case you're now exposing yourself to additional liability. Joanne, would you agree with that?
Absolutely. And when I describe it to people, I always say the company, the entity structure that you choose is really like a garage. And if it's not properly built, whatever's inside will not be protected. So if the door is up, when the storm comes through, like the Ferrari's taking a beating, and that's not why you bothered to form it. So sometimes people are like, well, I'm going to form an LLC, but I don't want an operating agreement because I'm trying to save money. And it's like I hate to say all or nothing, but like, it's really almost not worth it if you're not going to do the whole kit and caboodle, because you are still leaving the door open. And it's like Marina's favorite saying, the devil's in the details. That's always where the problems lie. So
yes. And to your point about the LLC, I mean, that's a good segue into the LLC. This offers the same liability protection as a corporation, except it carries so many less requirements. You're not required to have an annual meeting. You're not required to have directors and certain officers. You may have a manager, but you may also elect for the entity to be managed by the members. So from an operational standpoint, it is very much more simple than the corporation. However, I want to note that just because it's more simple doesn't mean there aren't certain governing requirements. So you still have to do some corporate housekeeping. And what's really important, I think, for LLCs is making sure, and it really in any governing documents, whether they be bylaws or your operating agreement, you really want to make sure that you're providing those who will be managing the day-to-day affairs with as much flexibility as possible. Because if you put parameters in there that are too strict, you're going to end up not abiding by them. And then that goes back to eroding that corporate veil I was talking about, because you're not operating in accordance with your own governing documents, with your playbook. If you play by your playbook, when the court looks at you, they will determine that, yes, this truly is a sovereign entity and not just an alter ego of Jackie Durham. So you really want to make sure that you're working with your attorney to craft these provisions to say, I want my manager or my authorized member to be able to take these actions without coming to me and getting my signature. And without an operating agreement where you're giving your management that kind of liberty, now you're subject to Florida statute. And that means Florida statute is going to dictate what you can and cannot do without authority. And that's going to be much more restrictive than what you could otherwise achieve with a properly tailored and crafted operating agreement or set of bylaws. So,
and then on the tax side too, we're back to, again, now you have the legal entity, but until you reach a certain amount in income, you're still very much available to use that Schedule C, profit or loss, on your individual tax return. So you don't have to necessarily immediately after forming an LLC incur the cost of filing a separate tax return and doing all of that stuff. So your tax filing and reporting is still very simplified. And you just now, though, because you are a different entity, you need to really spend some time on not commingling, keeping track of your income and expenses separately. So this is a great segue into, hey, now I'm a kind of a toddler business. Now I'm not an infant. And this is going to get me ready for when my business is in a size where I have to have other people and I have to have systems in place. So let me start setting up a bookkeeping or record keeping system of some sort. Let me make sure I've got a different card for business expenses versus personal expenses, and really start, your behavior has to change there. But you're still, we're still watching you from the point of view of how much money did you make before we get into some of those tax selections that we'll talk about shortly. But it's definitely, it's like a whole different ball game as well for tax. The other thing too is, as we'll get into the discussion of these tax selections, is once the LLC is formed, we have a whole lot of flexibility on when we can elect for you to be treated a certain way. If you don't have an LLC, I cannot backtrack for you. If you've got an LLC and we determine that you should have been an S-Corp for the full entire year, I can do that. But if without having a legal entity in place, I cannot backtrack your formation. So that sometimes also is what, like, I tell my clients, Joanne, if I cannot get them on liability protection, I tell them on the tax election, I can make you an S-Corp if we need to be an S-Corp, but give me an LLC first, and then I can do an S-Corp when the time is right. But I cannot backtrack both of them for you.
Exactly. Especially our realtor friends. Like that's who I think I yell at the most.
Absolutely. That is true.
Yeah. So, and I think, one last thing I would just note about the different entity structures is, you need to pay close attention to the officers, the directors. When you are a corporation, there are different qualifications for directors in terms of, there's a defined term under the statute called qualified director. You need to make sure that who you're appointing is actually qualified to be a director of the corporation. This can vary based on what other kind of business they have going on outside of the corporation. I feel like some of those restrictions are not as apparent with an LLC. So again, another reason why an LLC is a little more flexible. But at the same time, if you do have management or directors, if you're a corporation, who are going to be operating in other related businesses, competing businesses at all, you want to make sure that your attorney is properly crafting certain language into your governing documents that permits them to do so. Because if they're not deemed to be qualified to be acting in that capacity under Florida law, their actions may not be deemed to be authorized, which can have a cascade of implications. So it's just important also to make sure that when you're forming these entities, that you're really contemplating who is going to be operating the management. You know, if you're a corporation and you're just a shareholder, you're not necessarily going to be participating in the day-to-day management. It's really more crucial looking at who the directors are going to be, who the officers are going to be. And of course, if you're an LLC, looking at who your managers or authorized members are going to be. So those are the main points I wanted to touch on with those.
And to tag on to that, you also want to be cognizant that if you think you might sell part of the ownership of this company or bring on like a key employee, like a lot of times I see people, they're like, well, I'm going to start it just now, but my plan the whole time is that Jackie will be an owner too. And I'm like, well, we should just do it right to start with. Otherwise, you're going to be looking at legal and tax implications and costs to add that person properly later, because frequently people feel like, oh, I just went to Sunbiz and did an amendment and added Jackie. Well, that's really not the legal way to add Jackie. And of course, Marina has a heart attack when someone hands that to her as their proof on the tax return side, or the napkin, even better. Like, I meant to add Jackie, so you should put her on the tax return. And it's like, well, that's not exactly how this works.
Right.
So we want to make sure that we've got even authority to do that. So as Jackie was saying, when we look to the operating agreement to see who can do what, how many people do we have to start with, and do we have unanimous consent, or do we need majority rule? All of those types of things are what are outlined either in the operating agreement or the bylaws, depending on the entity type that you have. It's telling you how to make decisions, not what decisions to make, but it's trying to give you that playbook so that you know whether or not this is something that all of the owners need to agree to, or most of the owners, or supermajority. It avoids dispute, because it's giving you the rules on how to move forward on an unlimited number of things that you couldn't possibly contemplate at the time that you create those documents. So it's really the way you make how we make a decision, not what decision we make. So that's why these documents are so important.
And you know, there's plenty of times where you go in and everyone's best friends and hugging and, you know, cheersing, and that's great. And hopefully it stays that way. But many times that's not how things end. And the more clear the rules are, the easier it will be for a court to enforce that as well. Because, you know, sometimes that's where it ends up. And if you don't have, you know, bylaws, a shareholders agreement for a corporation, or an operating agreement for an LLC, now you have to kind of negotiate how things are going to fall out. And many times it just results in the court ordering a dissolution and selling off all the business assets. And that doesn't always end up with the best allocation of the assets to the members or to the shareholders. And it's just best to have these things ironed out in advance. And like Joanne mentioned, it, you know, knowing and being intentional about who needs to approve what percentage ownership needs to approve certain actions, outlining that is going to give you so much more security that your partner, or not your partner, but your co-member or your co-shareholder or director can't go out and do something without the requisite consent that everyone would prefer. So
absolutely. And on top of that too, as things do start to deteriorate, we have seen in situations where co-owners of a restaurant have a relationship that deteriorates. And on my way out, I order a bunch of perishable items because I have authority to do so with the vendor. So I ship, you know, 20 pounds, 2,000 pounds of tomatoes, knowing that they're going to spoil and that the company's going to be responsible for them. So if we have that stuff outlined, then we take the proper steps to make sure that that actual or apparent authority is terminated, so that those things can't happen. So it's important on the way in, it's important during, and it's important on the way out. And also, like you were saying, you don't want to have a company that's otherwise functioning well fall apart or be torn apart because of a dispute, when we could have that company continue to survive and be operated by one of the partners or owners.
Right.
So.
And you know, one more thing I want to mention, I've mentioned this in past webinars, and I'm just going to say it again because unfortunately I've seen several of my clients stumble into this issue. you know, there are certain fiduciary duties that fall under Florida law with respect to corporate shareholders and LLC members, but they're not the quickest or easiest thing to enforce. And it's pretty expensive to fight about the extent of that fiduciary duty, and, you know, what the ramifications are for a breach of that fiduciary duty. So if Joanne and I are members of an LLC, and while I'm still a member of the LLC, I go out and either open up my own law firm or compete with her in some other way, yes, there's a fiduciary duty that I'm breaching, but it's going to be a little more difficult to enforce unless we have specific restrictive covenants in place in our operating agreement or via a separate agreement. When you have that, it gives you certain equitable remedies, such as temporary injunctions and things like that, that are going to be a lot quicker and easier to enforce in a court, and will require a lot less time and litigation and attorney's fees. So that's another thing you want to, you know, keep in the front of your mind whenever you're bringing on new members, bringing on shareholders, or even forming a new entity. I'm forming a new entity right now for someone, and we are going to have those restrictive covenants in place from day one. So, you know, just something else to keep in mind. And I think that's a good place to stop with some of the legal considerations so that Marina can jump in and discuss the LLC versus S-Corp.
My favorite.
Questions that we get all the time.
My favorite. Well, before I get into the S-Corp election, I did want to point out from kind of my side of the experience with, you know, the importance, as you guys have discussed, on the operating agreement and giving various members the rights and the responsibilities and describe what they're doing and how much money they can spend. And it actually works in the same way on if you've got an LLC that's going to be treated as a partnership, and we'll talk about that in a few minutes. But if you want your income and losses and capital allocated in a different way than just a default 50-50 or a third and third and third, that's a place to put it. And this is where I always see it on the end. So let's say you've got a partnership that's invested in real estate, and you've got a guy who's bringing in the money, and then you've got a guy who's managing the property. They may have different interests, and they have discussed ahead of time, sort of in the napkin, you know, over drinks, that it's the guy who put in the money. All he wants to do is maybe get his money back with a little bit of, you know, a little bit of money on top of that. And then the guy who's managing it, he really wants to just keep working in it and so on. So what they may agree is to say, you know, when we ultimately sell this piece of real estate, I'm going to pay all the tax on the gain, but you're going to take over kind of the operating income and loss on your side, and you pay tax on that. You can do that in the operating agreement. That's exactly the kind of stuff that you can do. If you're going in and you have no operating agreement and you say we agreed, no, because if at the end of the day you've got a lot of money and then you give them the K1 and they look at the K1 and they realize how much tax they have to pay on the gain, and then they say, well, I didn't mean to put half of this gain on my side of the tax return, and we say, well, where in the operating agreement did you tell me that the entire capital gain goes to the other guy, and you're only going to be taking over the loss? I have the situation more times than I care to even imagine of it's the K1 time. It's the time when it's the K1 and they have to all of a sudden say, whoa, why does it show $500,000 on my K1 from the capital gain? And I'm like, well, you told me you guys were 50-50 partners, and without any further you know, information, this is how I'm treating you. So this is your place to outline exactly how you want the income, profit, loss, capital to be split, because you can customize it in the way that you want it, particularly when we're talking about the partnership tax entity. So let me kind of segue into the different tax entities. So we've got our LLC formed, and let's say you're a single member LLC. You, again, don't really need to start filing a separate tax return quite yet. We usually use a threshold of roughly $50,000 of net income, and that's where it becomes worthwhile to do an S election so that you start filing a separate S-Corp tax return, because the cost of preparing the tax return, getting you on payroll, and doing all the quarterly filings and doing a little bit more of the planning are worth the savings of that self-employment tax that you are otherwise subject to. So if you're just operating as a single member LLC, for tax purposes, you're still considered self-employed, which means that any income that you make is subject to not just income tax, but those self-employment taxes. So we are kind of watching the timing on when we want you to be an S-Corp. And sometimes, especially like Joanne says, my realtor friends, they start out with a PLLC at the beginning of the year. They have no idea yet how much money they're going to make. So we're kind of like, we don't really want to make an S-Corp election because I don't want to shove you into having to file a separate tax return quite yet. We get to the end of the year, we realize they've had some great commission closings at the end of the year. We say, now it's definitely worth for you to be an S corporation, because now on your net commission income, you're going to pay so much in self-employment tax that we definitely want to get you that favorable S corporation structure. So what I do is I prepare an S corporation tax return, and then with it, I send the S corp election to say, we want it to be an S corp all the way back to when we formed at the beginning of the year, and IRS will take that. There's specific verbiage you have to include with that election to say that I meant for this to be at the beginning, but IRS knows their small business owners have no idea what they're doing. So it's to give you an idea of how much they distrust the small business owner. They're actually giving you 3.5 years to backtrack that S election. So you've got plenty of time to look back and say and make that S election. So once the S corporation election is made, you still will always remain for legal purposes an LLC, but now for tax purposes, you are considered an S corporation. Now, because you've put yourself in the S corporation for tax, now you have to comply with the S corp rules. So certain things that you would think, oh, if I was just a single member LLC, now I have to worry about this built-in gain tax on capital assets inside an S corp. And that is all true, because now you're governed by the IRS as well, not just the LLC rules of the state where the LLC is formed. So you do need to be well aware of both the legal LLC rules and also the IRS rules to make sure that whatever you do for tax still makes sense in your life. And this is the kind of discussion we would have with our clients, is to say, hey, how much money did you make? Okay, if we can maximize your deductions, maybe we don't need an S corp election quite yet, but now you're in a land where now you've got the savings are worth the costs of filing, putting you on payroll, et cetera, et cetera. And I'm not going to get into sort of, how much the payroll or any of that. We've had those webinars, and our viewers are more than welcome to go back and listen to that. But the idea is that now we got a choice. Now we have a choice on the timing of the S corp election, the type of entity. Maybe by the time you want to be an S corp election, maybe you want to bring another, partner or another business owner with you, or another member. That's the time to get them in, and then the S corp election will definitely reflect that. So typically, the type of entities that will fall into the S corp election would be any entity that's generating active business income. So it would be income that's considered earned, meaning subject to payroll tax, and that's your just your typical Jackie's shingles will be perfect for that, because if you're self-employed, you would be paying payroll tax on that. Anything that has to do with real estate holdings is not subject to payroll tax. So if you are generating rental revenue, or you are an investor, you are definitely not subject to payroll tax. So you have a lot less need for the S corp there. And in that case, what we would say is, if you're a multi-member LLC that's got real estate investments, what you will be filing is a partnership return. But it's also important that your CPA who's preparing that return doesn't mark you as a partnership, because you did not form as a partnership. As Jackie said, you formed as an LLC, but for tax purposes, you have now defaulted into being a partnership because you've got more than one member. So these are all important things to sort of balance your understanding of what you are legally and then what you are for tax purposes. So I love the partnerships. my real estate investors, they are all partners in a partnership. It's absolutely fantastic. Again, the flexibility to assign who gets what, how the income loss is split, who puts money in. It's absolutely great. And the tax return is you know, it's pretty easy to understand. Everybody gets a K-1. All the partners get a chance to review. The other thing that's also important is, you know, for us, for example, as a CPA who's preparing a tax return, which one of the partners is going to be the guy who's going to review and sign the tax return and give us the authority to e-file. And that's the kind of stuff that we want to be outlining in the operating agreement as well. Makes sense so far before we kind of dig into a little bit of the C-Corp piece of it?
Yeah.
Any other notes, Jackie or Joanne, on the tax piece of the S-Corp versus partnerships?
Well, I was just to your point about making sure your operating agreement, if you are an LLC, or your corporate bylaws, if you're a corporation, designates who is authorized to represent the company in any kind of IRS audit or collection action or anything like that. I think it's now called the tax matters representative, if you're an LLC. And that's kind of a recent change to the terminology that's used in the Internal Revenue Code. But it's really important to have things like that in there, because you won't know who's actually supposed to go forward and communicate with IRS and attend interviews and those fun parts of the IRS audit that unfortunately some people have to go through. But it's good to have someone designated up front for that. And we always include that in the operating agreement for that reason, so that there's not a squabble or additional unnecessary discussion when the time comes and there is an audit, for the members or the shareholders to agree to who's actually going to step forward and take on that responsibility.
So I wanted to talk for a few minutes about our traditional C corporation, which is what a lot of people think about when they think about the corporations. And again, this is something that we can elect for tax purposes after you've had an actual LLC formation. So there is an election form for your LLC to be treated as a C corporation. The C corporation is not the common way anymore to run your small business. There's definitely pros and cons. Without getting into too much detail, where we do see your traditional C corporations present is in the type of industry where you're developing a product that you may plan to sell your corporation in a few years. Currently, there's a favorable tax treatment on sale of what's called small business stock, which has to be the stock of a C corporation. And if you hold that for a certain number of years and then you sell the actual stock that's appreciated in value, you can completely get rid of paying any capital gain on that stock. So it's an absolutely fantastic strategy for those businesses that get in. They don't make much money, so they're not really paying a whole lot of tax during the duration, during the life of the C corporation, because it's really not spitting out too much income. It may be developing an app, developing some sort of a product. And so the value is going to be really the value in the stock when you're maybe absorbed by a big competitor, or, you know, it's going to be something like that. And then you're chasing that favorable tax treatment. So you're kind of willing to put up with the C corporation for a duration of time. For a small business that is actually where the owner is actually living on the money that the business makes, C corporation is not the best tax strategy, because the corporation itself pays tax, and then when it declares dividends to you as the owner, you pay tax on those dividends. And thus you hear that concept of double taxation. A lot of times people say, well, I'll just zero out the C Corp income by paying myself more salary. Sure, but now on that salary, you're paying that payroll tax. So that double tax is chasing you in either place. So there's definitely time and place, and we look at our clients. It's a case-by-case situation, and we say, you know, maybe C Corp is a place for you. Some businesses start out as a C corporation because they didn't know any better, and maybe that's how they formed years ago, and nobody's advised them that they need to be something else. So we look at their case and say, you know, you should really be an S corporation, because none of the benefits of a C corporation that you were sold back in the day are really that unique that you cannot get these write-offs as an S Corp shareholder. So You know, a lot of times people would write off a lot of the personal stuff and the benefits and health insurance. Those things are still all available to you as an S-Corp shareholder. There may be one or two things that's slightly different, but the meat and potatoes are going to be the tax benefit is the same, and you're definitely getting rid of the double taxation. The other thing is with the C-Corp, if you've got a foreigner that wants to own a company in US, that sometimes is their only choice, is to be, they will come in and they'll form an LLC, and then they'll elect the C-Corp treatment because a foreigner cannot own an S corporation in US. So oftentimes the foreigner will either be a single member or they can be a C corporation, depending on a slew of other factors that they may be subject to working with their tax laws back home and how all that stuff is reported. What we found as a kind of a side note with the foreigners is that the concept of LLC is not necessarily translatable to other countries. So depending on what they end up doing here, I always advise them to seek the advice of a cross-border person or their tax person back home, because sometimes we will form an LLC for them, but back home that LLC is automatically defaulted to be considered as a corporate structure in US, and then the way they have to report it back home is more complicated. So sometimes doing a kind of the LLC treated as a partnership is a little bit more friendly for them. So it really, again, is case by case and depends on what kind of activity they want to do. If they just want to invest in real estate, or they actually are interested in doing an active type of business, selling a product or, you know, things like that. So their structure, but sometimes the foreigner versus a US person will push us into one structure or the other as well. So there's definitely a lot of the considerations, but you can kind of see how we start out with one type of legal entity, and these are our choices. Now, Jackie, let me ask you, if you, as far as the C corporation is concerned, because there's that election form as an LLC to be treated as a C Corp, does that push you in any way, shape, or form to add any more corporate formalities by being a C corporation for tax purposes, if you're still an LLC legally?
I mean, what we try to do is put in provisions into our operating agreement that will tie to whatever the current election of that LLC happens to be. So you might start out as a sole proprietorship or a disregarded entity, I'm sorry, for tax purposes as an LLC. And then you bring on a new member and you are adding them to your LLC. So they're becoming a party to the operating agreement. Now the entity is taxed as a partnership. And later you may want to elect to be an S corporation or a C corporation. If, for instance, that member happens to be a foreigner and you need that foreign investment. So you want to make sure that either A, your attorney is reviewing and updating your operating agreement as your tax election changes, because it could very well affect those provisions, or that your attorney has crafted an operating agreement, which you want to make sure you confirm with your attorney this information, that it is crafted in a way to where it will be flexible based on the various elections that the entity may make throughout the life of the entity.
Yep, absolutely. And I also have to say, when we talk about these corporate formalities and people say, well, I'm an LLC, you know, my attorney told me I don't have to really worry about the corporate book, and that's all great. But I say, you know, for tax purposes, if you're making a decision that we say you need to have some sort of a tracking for it, still document, still say that I've had a meeting, and then in my meeting, I have decided that I am going on this trip, which is has a business purpose. And then on the trip, I have an agenda for the meeting that I held, so that I, you know, have a documentation and support for why this particular trip was a business trip. So just because you are an LLC and you ease up on the corporate formalities doesn't mean that for tax purposes, you should just completely ignore it and then try to figure out how to prove it to the IRS auditor that this was a trip that was business related, or you've made a certain decision. So having that documentation, that even if it's just you, but you thought about it, you know, had a meeting with yourself, you wrote down the agenda, and then this was your intent to incur this expense because of this, or to get into this line of business because of that, that is all documentation that is going to help you on the IRS side. Never mind, you will never use it for legal purposes. So I think that's why having those meetings, and especially if it is more than one member. I always say, have your annual meeting, have your quarterly meeting, make a note of what you guys decided to do. That's going to be fantastic to support why you made this business decision and why you wrote things off, or why you created this income, or what you did with the property. It's definitely the keys to document for tax.
Well, and not only for tax, but just, we touched on this before, but that example you just gave, Marina, I think is a very dangerous comment for any professional to make to their client. Just because the LLC is less cumbersome from a governance standpoint does not mean that there are not certain company actions that have to be authorized. If you change employees, if you decide to bring on a new member, or transfer ownership interests, or sell off part of your assets or all of your assets, there's certain company actions that fall outside of the normal course of everyday business. And that line can be a little fuzzy sometimes, which is, again, goes back to my point. I know I'm beating a dead horse here, but it goes back to my point about making sure that your playbook is crystal clear, and your playbook being your operating agreement, because then you're not going to really know, well, what calls for a member vote, and what can my manager do without bothering me for my signature on this written consent, the 8th one I've gotten this month, because my operating agreement isn't written well. You know, that's the risk you run. And then if you don't paper it properly, and if you don't authorize things properly, then when stuff hits the fan and you have a creditor coming after you, it's going to be that much easier for them to pierce that corporate veil and get at your personal assets and those of your members.
And speaking of corporate playbook, we do have a question that says, what's the best place to order a corporate book?
Through your attorney.
The thing you have to be cognizant of, folks, is that there's lots of companies online that are selling these corporate books, and they send you a big fancy seal, and they are charging like pricey for these big metal like embossing seals. That's not really doing anything. It looks fancy. My brother-in-law's check, and he's like, the more stamps the better, like it's more official if you can put more stamps on it. Whenever I notarize for something for him, he's like, can you put 3 or 4 on? I'm like, just 1 is fine, like it's notarized, like it's not more notarized. But those things are really meant to just be money grabs. They're really not providing any safety or effectiveness to the company. So when you say corporate book, this could be digital or a physical binder, and it really would typically house your articles of organization. It would have your tax ID application when you receive your EIN from IRS. It would have any elections that you've made. So if there is a 2553 S corporation election, once the IRS confirms that, they send you notice that you've been accepted. You'd want to keep that. It's kind of your permanent file, the things you want to keep forever. Also, the operating agreement or bylaws, depending on whether you have a corporation or an LLC, should live in there. Any record of transfers, if you've tried to sell shares, the documentation from that ought to be all in one place. So that way, everything having to do with the company really lives in this book. And the book can be on a server, on a Dropbox, or in a physical binder. But it's really not something that you order and purchase. It's really something that you assemble with the important documentation that relates to the company. Anything they're selling is really not something that you need.
And some people like to have that nice leather bound corporate book. It's sort of old school. It's the same. It looks nice. And you know, but a lot of people forego that because it's just an additional expense. It's the guts of that corporate book that matter. And like Joanne mentioned, those can be stored electronically or in a $3 binder from Walgreens. So. And
if you're on LegalZoom, they're happy to send you the binder with a bunch of documents in it that are blank, and that's not helpful at all. So, you know, like people sometimes are like, let me see your operating agreement, and it's like the operating agreement of blank on the date of blank 20 blank for the year. Like that's not an operating agreement. That is a bad template, but it's certainly not. And people just don't know, and they don't want to do it wrong, so they just leave it, and then they feel it's false sense of security. So it's like you have a screen door on your garage instead of like a big steel hurricane proof garage doors. It's like I feel like I have a door, but it's going to blow off the second that there's any kind of problem. So just something to be cautious of. It's that false sense of security that really worries me with people.
Well, in you know, those forms are made for everybody, and whenever you are creating an entity or really doing anything from a legal standpoint, you need to make sure you have someone in your corner representing your best interests. And the way that, your attorney will craft an operating agreement to protect you is going to look completely different than some vanilla template that is meant to apply to everyone. So there's unintended consequences that can accompany something that general and templated. So it's, just because you have something, yeah, sure, it might be better than nothing, but it might also impose some complications on you that you didn't even contemplate.
It may be worse than nothing.
It may be worse than nothing. It may do more harm than good. So,
and people don't necessarily think that that's the case. So thank you so much, ladies. You have contributed once again a wealth of information, and I love doing this with you guys because you are smart and funny, and I love what we're bringing to folks. So for those of you who are out there, we are interested in what you'd like to hear about. So as always, please email us your topics and things that you would like to hear about. And we are about to take a break. So we're going to be off for 2 weeks for the Thanksgiving holiday. So we won't, if you miss us, you can go to the recordings and watch some tax or Jackie out.
Or if you can't sleep,
call Jackie and she will she'll get you there. So we'll be back in 3 weeks, I guess, with John Cipher, and we'll be looking at some more ways to improve your business. So from a development standpoint. So if you need anything, let us know, and we're happy to help you. So we're coming up on the end of the year, and it's still been 2020. So stay tuned.
Very true.
Waiting for New Year's to see if 2022 will actually be different. Maybe there will be an end to the tax season.
One day.
Thanks, everyone. Have a great week.
Thank
have
you.
a great week. Thank you.